Here this week potentially. The question is why? I know last week we were absorbing that strong jobs report and maybe getting used to the idea that the Fed was going to raise rates. But this week, with the strongest week, it became even more evident that the Fed is likely to raise rates next month. So what's going on here?
Well, I think investors are finally getting comfortable with the potential of a rate rise in December. Like I said, I'm still not sure about that. But you know what? As far as the investors are concerned, the economy is doing fairly well. You look at the earnings mostly across the board. Most of these companies can pretty much absorb a little bit of an increase in their borrowing costs. So it's not going to be the end of the world. And the thing is, if we have a 25 basis point rise in December, if they can come out and say that we will probably have another rate rise at some point in the first quarter of next year, clarity would be very good. It would help a lot of people, understand what it's going to mean to earnings going forward.
Rick, a quick word here as we keep an eye on why these stocks are moving around off their lows. Some people were chattering about some Fed moves today.
Yeah, listen, I know the stock market had a good week. I like the way Bob talked about it. In a matter of a couple weeks, we went down 3%, up 3%. The market may be getting more comfortable from an equity perspective, but we're still a couple weeks away from the meeting. And I contend investors are a little trigger happy, but they're not contesting the move. And let's face it. There's a lot of liquidity in equities, at least for the most part. So I'm not sure how many conclusions we can draw from that. But if you look at the fixed income markets, it's rather compelling. There has been major flattening, no matter which part of the curve you combine with any other part of the curve. 2s, 10s, 510s, 530s, they're all flattening. And that indeed is due to the notion that there may be a fixed income comfort factor there. And of course, when you look at what's going on with the dollar, it's going to pay attention to what rates are paying attention to. But how it turns out for equities is anybody's guess. That's why normalization is so important. We all hope it holds all its gains and it moves even higher. But that comfort factor, that knowledge still is elusive because of policy.
So Jim Kahn, where do you put your money then right now? If it's, if we're all guessing that rates are going to go up, do you go with the defensive plays or do you stick with anything that you feel is growth oriented right now? What are you doing?
So I have to disagree with Rick a little bit. One of our clients are asking us questions that are very similar. What's going to happen with equities if interest rates start to rise? And if you go back and you look at the last 4 cycles of tightening, equities have actually done quite well. And if you look at the underlying reasons why, it goes back to some comments by Fed member Bullard, which is they are going to respond to the data. And so they're unlikely to continue to raise rates in an environment where the economy can't handle such a hike. And so generally, if the economy is growing, if the expansion is actually accelerating as opposed to contracting, you should see corporate earnings and margins respond positively to that. And over time, you generally see higher markets at the end of rate tightening cycles than you do at the beginning. So we're right at the beginning, and we would expect that when we get into 2017 and rates have gotten to what's more of a normal level, that the equity market's going to be meaningfully higher. So we're not afraid of equities right now in the face of rising rates.
Perspective on that this hour. And everybody, I thank you for joining us.